And Frances Donald, she's the chief economist at Manulife Investment Management, joining me on the desk. Thanks so much for being with us.
Thanks for having me.
So, no surprise, they're probably not going to raise rates this time. What do you think they're going to do after this meeting?
Well, famous last words, no surprise. Let's hope not. But there's a lot of information we could get today that isn't about did they hike or not, but could be very relevant to how markets are going to trade and what happens next to the U.S. economy. The really big one is that last time we heard from the Fed in their summary of economic projections, also known as the SEP, if you're at an Economist party, those told us that the Fed thinks that the most likely course of action is 4 rate cuts in 2024. And that's about what the market's pricing. What we want to see today is, do they still think that? Inflation's coming down, that job market's softening a little bit. Is it 4? Is it 3? Is it much more than that? That's going to be much more relevant. But at the end of the day, Amber, it's probably not going to be 4. 4 doesn't make a good deal of sense to me. It's probably going to be 0 or substantially more as we head into a recession and an easing cycle. My bets are it's going to be more than 4. So this 3, 4, 5 today, that's really signaling how their change in thinking is moving forward. I wouldn't take it as a literal interpretation of what will happen next.
And they've said that too. You know, the dot plots are not law. It's just sort of where we think things are going, and they're dramatically different year to year. So that's interesting. You think we could get a more dovish outcome in 2024. And I'll counter that with everybody's concern, oil prices. And
oil
how that's
prices,
going to feed into inflation.
Huge problem for the economic environment and also for consumers across the world, because we know that even when gas prices rise, people don't generally consume a lot less gas. We got to get to school. We got to get to work. So it acts as a tax on other forms of spending. Maybe you go out a little bit less. You buy fewer things because you have to spend more on gasoline. But the big problem for central banks now, and we've heard a little bit of central bankers talking about it, is nothing the Bank of Canada or the Federal Reserve does is going to stop floods in Libya or increase production in Russia or in the Middle East. So they're in a pickle, which is they've told us time and time again, we can and we will cure inflation. That's our job, but they can't. And they probably won't. So something's going to give.
I know you're not an energy economist, but I gotta wonder who's buying oil at $92, $93 per barrel. We just had the OECD come out yesterday say best case scenario for global growth 2.7%. You know, like it doesn't really make sense. Supply doesn't seem that restrictive.
This is one of the issues and why this has maybe caught many of us off guard. This huge increase that's occurred, because on the demand side, which is where economists actually have some visibility. We're not so great on when it comes to the supply side. You know, China's very weak. Europe's in a recession. Canada's probably in a recession. The U.S. is in a downfall. The demand side of the equation is very, very weak. But supply of oil is generally not something that's capable or most economists can look at and get a good insight on, just like a lot of the problems that we're experiencing in this environment come down to individuals making decisions, not charts or models. How central banks choose to respond to changing natures to inflation, how they weigh the balance of inflation versus a deteriorating economy, how governments choose to make decisions. These are not things that standard economic models can really help us with. We're making educated guesses. That puts a huge confidence band around where the economy is going next and really needs to inject a lot of humility into your outlook.
Right in the middle of that, you said Canada's probably in a recession. Why do you say that? I didn't let you get away with that one.
No, I'm happy to talk about it because we should be talking about it. We've already had 1 quarter of negative GDP. Most of the economic data tells us things are getting more difficult. So remember, when we talk recessions, it seems like a really big word. We're generally talking about a rise in the unemployment rate and 2 quarters of negative GDP. I'll be forward with you. Right now, we're talking about 0%. So I'm not sure at the end of the day, is negative 0.2 and 0 going to be a recession? Or are we going to just play, whatever narrative you want to build with that? The more important story is that growth is deteriorating and the unemployment rate is going to rise. And how we characterize that and what narrative we choose and whatever gets you the best headline is less important for Canadians and investors than the narrative that things are slowing and slowing fairly dramatically.
Well, I want to put this all together. Your view that the Fed is going to be more dovish and against what happened in Canada in the last 24 hours. Inflation picked up. We had a speech from the Deputy Governor, Sharon Kozakian. In fact, before I even ask the question, here is a little bit about what she said yesterday in her speech with respect to inflation. Take a listen.
Because inflation was very high last year, interest rates had to rise a lot. And that's why we forcefully and brought them up quickly. Inflation's come down, but it's still too high. And that tends to mean that real interest rates need to remain high.
Real interest rates need to remain high. Is that actually going to happen, though, if we're starting to see signs of a slowdown?
So I love coming on your show because I was going to say today, why is nobody talking about Deputy Governor Kaziki's speech? This was so important. We're all focused on this headline inflation. But of course, you have a clip right here. Now, in that speech, she talked about the ups and downs in inflation, her words, not being abnormal. And she also said, and this was really important, she said, yeah, we know if we don't do enough, we'll have to do more later, and we're afraid of that. And then she said something powerful. She said, we also, other side of it, want to make sure that we don't unnecessarily harm the Canadian economy. We talked earlier about these little changes.
So your takeaway was this was a dovish?
No, I think it was an introduction of balance that is going to give us some perspective into how central banks don't have the luxury anymore of saying all inflation is bad, but will have to be more focused on what are the things that they can control. They cannot control oil. They cannot control food. And should the Bank of Canada be raising rates because fiscal, should they be raising rates because mortgage interest costs have risen and pushed up CPI? Some people will push back and say, why do you do CPI X mortgage interest rate costs? Well, we shouldn't. If we're talking about the general Canadian experience, that's very real affordability problems. But should the Bank of Canada respond to their own policy increases? Yeah. So when we strip these things out, what we see is that core inflation, when you take out mortgage interest rate costs, is running about 2.6%. And while I don't have any particular insight, I would put strong bets on the Bank of Canada looking at those types of numbers because they know that's what they should be targeting. It is not the same thing, and the economic discourse in Canada gets lost on this. When we strip those things out, we're not saying we're trying to negate the experience of Canadians because affordability and CPI calculations are not the same thing, and that's the missing story.
I hear your point, and away from this debate, though, if Canadians get a whiff of this, it seems, the housing market, I mean, think of how much has been thrown at the housing market, policies, taxes, unprecedented rate increases. And there's barely a blip when it comes to, the pullback. It is not cratered by any stretch of the imagination. Then you want to pause on top of that?
Well, when are we going to start to have conversations about how interest rates maybe isn't the main driver of the housing market? And maybe we shouldn't unemploy people to compensate for policies that have brung the demand supply together? How many people are going to have to pay either by having to sell their house or lose their job because we have other policies that are creating this problem? We're going to have conversations about what the Bank of Canada can control and what it can't. And housing, I think, is increasingly going to be part of that discussion because you know what's bad? High prices in housing. You know what's worse? High housing prices and no job.
Yep. And so your final thought on whether the BOC is done or not, do you have conviction?
I think they're done, but they can't tell us that. To your point, inflation expectations are really important. I don't think we should eradicate the chances of it altogether. Over on the asset management side, when I talk to PMs, we look at all possible scenarios. There's another CPI report coming. Yeah. My main view, my base case is they are finished, but we don't ignore the possibility that one more might be in the cards.